Good morning, trading family. Welcome back to the Trading Floor. Yo, what's poppin', you absolute market carnivores? We are live and the tape is straight up unspooling. I'm Wildcard, he's TB, and right now 3 shocks are colliding in the same session. TB, disclaimer, you're up.
Standard reminder, nothing we say is financial advice. We're 2 traders talking markets, not telling you what to buy. Do your own work, know your risk. Now let's set the table with what actually happened. Yesterday, the Qs closed down 1.87%. The SPY dropped 1.26. The small caps in IWM gave back 0.6%. That's not a normal dip. The tape is finally breaking its 2-week habit of brushing off every headline. Pre-market this morning, the Qs are up 0.5%, SPY up 13 basis points. That's thin liquidity noise, not a turn. Do not read into it.
Let's draw it in plain English, because the map matters more than the price. 2 choke points. First, Bab el-Mandab. That's the strait between Yemen and Djibouti, bottom of the Red Sea. That's where the Houthis hit Saudi-flagged crude tankers this week. Not some random cargo ship, actual Saudi-flagged crude carriers. When you attack the flag, you're attacking the state. The Red Sea handles about 10% of global seaborne oil. If it gets tight, every barrel that would have gone through has to go around the Cape of Good Hope. Adds weeks and millions in fuel costs. Second choke point is Hormuz, at the top of the Persian Gulf. That's the big one. 20% of the world's oil passes through that strait every single day. Rubio was on tape this week saying, letting Iran control an international waterway and charge a toll under threat of force sets a dangerous precedent. That is not throwaway rhetoric. The administration is telling you they understand the stakes. The market ignored this for 2 weeks, 12 straight nights of U.S. strikes on Iran. Equities kept grinding higher. Yesterday that stopped. Brent punched through $100. That's the regime change. Under 100, the tape could hand-wave it as a spike. Over 100, it's structural. Insurance costs for tankers transiting the Red Sea have already tripled, and that does not reverse overnight. This is not a tradable headline. It's a shift in how oil moves around the world. And when oil moves, everything moves.
One thing I have to say here because our track record demands it. Oil geopolitics is the show's measured blind spot. We've called floors before that didn't hold, and crude just kept grinding lower. So I'm not going to sit here and call a new floor. What I will say is the regime above $100 changes the mechanical flow, but I want to see what happens when a ceasefire rumor hits or a back-channel deal surfaces. The de-escalation case is real, and we need to voice it. That's the counterweight.
Fair. I'm not calling a floor. I'm calling a structural premium that wasn't there 2 weeks ago. The House just passed a War Powers resolution, 214 to 208, and the war premium is getting priced into equities through energy and supply chains. That brings us to tariffs. This is not a tweet. The immediate numbers, 60 economies hit. 99.4% of U.S. imports covered, and it's built on Section 31 authority, not emergency powers. That last part is crucial. They rebuilt this to survive a Supreme Court challenge using forced labor justification that makes it much harder for trading partners to negotiate away. This is structural friction, not tactical posturing. It was designed to stick.
And the market translated that instantly. The Mag 7 shed $800 billion in a single day. That's the verdict. Their supply chains are the most complex, and permanent tariffs on that scale hit them harder than anyone. This is not a situation where a Friday afternoon tweet reverses it. The forced labor angle means you can't just call the trade rep and work out a quick deal. It's baked in.
Exactly. So you've got the oil engine and the tariff structure, both screaming that inflation isn't going away, and that shifts the whole risk appetite. Then overnight, the third shock hit. The KOSPI unwound 5.72%, and it's a feedback loop with a U.S. hook.
Lead with the transmission mechanism because most people just see a scary number. Is REX shares. 20% of their assets are tied to Korea, and 65% of their Asian ATS venue revenue comes from there. When Korean retail gets margin called on leveraged U.S. ETFs, they sell the KOSPI first. That triggers more margin calls, and those flows circle right back into US ADRs and the underlying stocks. The KOSPI is a 12-hour lead indicator for our tape. It tells you what happens when a leveraged unwind starts in a tight correlated market. The 5.72% drop was not a random local event. It was the start of a global flow squeeze.
And the overnight session proved it. Nikkei down 2.73, Hang Seng down almost 1%, Shanghai down 1.37. Europe is green this morning. DAX up 0.82, FTSE up 0.54, Euro stocks up 0.78. But Europe's on a different news cycle. catching up from before the war escalation fully hit. The pre-market US bounce is a vacuum. It's not a turn. The real flow story is the KOSPI unwind bleeding into our open.
And that's the top stories block in 3 pieces: oil structural shift, tariffs that were built to last, and a global contagion valve that just opened. Now we move to the calendar and what else is shaping the week. Earnings are thin. The only notable report today is American Express, AXP, consensus $4.41 a share. That's it. Nothing else notable the entire week. So we'll treat AXP as the consumer litmus test. More on that later when the print hits.
Economic calendar has plenty to watch though. Let's rip through it. Today, Friday, July 24th, the ECB rate decision. Expected hold at 2.4%. Lagarde may hint at September, and that moves the dollar. Overnight, we already got Japan National Core CPI at 1.6%, up from 1.4 prior. That's in the tape, no surprise. Saturday, we get UK core retail sales, consensus minus 0.4% month over month, after a plus 1.2 prior. That's weekend gap risk.
Tuesday brings US durable goods orders. Prior was down 4.5%. Terrible. Consensus isn't out yet, but watch core durables, which were up 1.4% prior. If that number softens, it feeds recession fear. Also Tuesday, Atlanta Fed GDP now holds at 1.7%. Steady, but fragile. Wednesday, we get BOJ Core CPI, prior 2.7%. That matters because if it stays hot, the yen carry trade unwind risk reignites. And U.S. consumer confidence, consensus 92.1, prior 91.2. If that misses, the consumer pain narrative hardens.
Then the big one, Thursday, July 30th, Fed rate decision. The current rate is 3.75%. Odds of a hike at this meeting sit at 38%. But the real bet is September, where odds sit at 82%. A hawkish statement next week could price in that hike. So every data point between now and then gets amplified.
Sector rotation is screaming what the market is doing with all this. 1 week leaders, the energy sector, ETF energy up 4.14%, XLU utilities up 1.58%, XLI industrials up 0.9%. Laggards, consumer staples down 3.03%, communication services down 6.45%, and consumer discretionary obliterated, down 7.31%. Money is flooding into energy on the war premium, and utilities and industrials get bid as recession hedges. The discretionary wipeout confirms both a tech unwind and a consumer pullback pricing. Energy is the only sector holding a positive trend that's not pure safety. War premium, tariff inflation bid, supply disruption. That's the flow.
And internationally, we already covered Asia's pain. The carry trade plumbing, dollar-yen, is dead flat, up 1 basis point, DXY down 8 bips, euro-dollar flat. No yen unwind signal yet, but if BOJ data next week heats up, that changes fast. China's Shanghai slide reflects both tariff fears and domestic weakness. Watch for any stimulus whispers over the weekend.
Now, the segment that's live and real right now. Portfolio hot news, the consumer stress test, AXP earnings. The hottest theme touching our book is the affluent consumer's resilience against an oil and tariff squeeze. My wave trader algo holds AXP entry, $352.51. Currently at $345.23, unrealized loss of $435. The position gets tested live.
And my TFT algo holds AXP2, same entry, same loss. But my personal gut call account is long the energy sector, ETF, entry 56.94, now at 59.38, up $85.70. I'm adding $2,000 of the energy sector ETF right now at the market, with a stop at 56.50. The structural oil premium thesis is printing, and I'm letting it run with tight risk. That ad just hit.
But the AXP print is the real-time data. If they beat the 441 consensus, the bull case is that affluent travel and entertainment spending holds up, delinquencies stay low, and guidance gets raised. That directly contradicts recession pricing and supports the soft landing crowd. My AXP position would get a reprieve. If they miss, the high-end consumer is finally feeling the pinch, cutting back on restaurants, luxury, travel, which confirms the recession narrative, compresses tech multiples further, and tests my stop-out level. The stock would likely gap down $10 to $15.
In second order, a miss hits discretionary even harder, already down 7.31%, drags on Mag 7 ad and spend expectations, and feeds the bond market's rate hike repricing. Consumer weakness plus sticky oil equals a stagflationary feedback loop. That's the risk. The energy sector, ETF position benefits from stagflation bid, but an outright consumer collapse eventually clobbers oil demand. So I'm watching closely.
We just got the alert, AXP reported. It's a slight beat on the bottom line, but revenue came in light and they did not raise full year guidance. The stock barely moved in the after hours, hovering near 345. That's telling. The affluent consumer isn't cracking, but they're not accelerating either. It's a holding pattern, which means the recession narrative neither gets confirmed nor broken today. My paper account stays underwater, no stop out yet. I'm sitting on my hands.
Yeah, and that's consistent. My TFT algo's position stays. I'm not touching it. But the energy sector, ETF add, is a separate thesis. It's not betting on the consumer. It's betting on the war premium and tariff inflation holding energy up. I'm managing that with the 5650 stop. The wave trader algo, TB. What did it see today? You had a crazy signal day.
322 potential trades screened yesterday. Only one met the bar. I didn't take it. The system was essentially saying almost nothing is buyable in this environment. My gut call account has a small BYD position, 64 shares, entry 87.15, now at 86.56, down a few bucks on a grand. Not worth talking about beyond that. The model spoke. Sit. I'm listening.
That's the systematic discipline. So let's close with what we're watching. Weekend gap risk. Iran situation does not pause. Any new Houthi attack or Hormuz escalation gaps. Oil higher Monday. Brent crude support at $100. Resistance at 105. SPY pre-market bounce is not trusted. Support at yesterday's low. Watch for a retest. The energy sector. ETF. I added with stop 5650, but the original position stop is 5430. I'm letting it run. AXP earnings are done, but watch for analyst downgrades Monday based on the flat guidance. And the Fed decision next Thursday is the big event. Any hawkish shift could tip the whole table.
And remember, don't chase the Friday green if it holds. Manage risk into the close. This tape is reactive, not trending.
That's the show. Keep your head on a swivel, keep your risk tight, and we'll see you apes Monday. Stay feral, stay sharp. I'm out.